You're going to love this interview. Just got done editing it. I'm glad I got it live for you. I'll be in the comments for the next 30 minutes hanging out, answering any questions you have. In fact, leave a comment below about data points or what you think is going to happen to the company, and I will respond to every comment. Additionally, if you're just loving the content, click the thumbs up and I will go and check out your profile as well and give your videos some love as well. In the meantime, enjoy the interview. Hello, everyone. My guest today is Steven Uster. He's the co-founder and CEO of a company called FundThrough. Before FundThrough, he was an investment banker in New York, first at UBS and then as a founding employee of Centerview Partners. Steven has an MBA from the Wharton School and a Bachelor of Commerce with honors from McGill University. All right, Steven, you ready to take us to the top?
I am.
All right, so your cool factor goes up, at least for my audience, when you leave, big fintech and you start your own company. So you're already ahead of the ball here. Tell us what FundThrough does and how you guys make money.
For sure. So we are reimagining invoicing so that small businesses can get paid instantly, essentially bridging that gap for companies that invoice their customers, and then those customers take 60, 90, sometimes 120 days for them to pay them.
Yep. Okay, so let's role play here for a second. There's a lot of people competing in this space, and really it's just a function of your cost of capital, what you're raising your debt at, and what you're lending it at, and there's a spread. So let's say a SaaS company is listening right now, and they have $100,000 in committed annual contract value. That's paid quarterly, and they want to get that money, 3 months ahead of time on each quarter payment. What could you offer them on a $100,000 ACV?
Yeah. So typically, by the way, we do work with SaaS companies, but our core users are either tech companies or non-tech companies that just invoice for products or services to typically larger customers, and then wait to get paid. But on that $100,000,
what's large, by the way? Sorry, Steven. What's large?
Well, so we have folks on our platform who have, $100,000 per your example. We have folks on our platform who have actually $10 million outstanding. That wouldn't be one invoice. That would be, a lot of different invoices. On the low end, we actually have folks on our platform who have $500. And these are just micro businesses who are selling typically to smaller businesses. But our sweet spot tends to be in the 100,000 to $1 million.
Okay, someone that's listening right now, if they are sending out invoices, could be 1 or 1,000 that add up to between 100,000 and $1 million. They're a potential great fit for FundThrough.
Yes, absolutely.
Okay, so tell us more. How does it work?
Yeah, so all you would do is connect a couple of your data sources, connect your invoicing platform. Let's say you use QuickBooks Online. All of your invoices would show up on our platform. You click the one that you want to fund. We would verify that invoice is accurate and that you've completed the work that you said that you were going to be doing or delivered the product that you said you were going to. And then the money will be in your account usually that same day once you're on board.
Okay. So again, let's be specific here. Let's say someone's listening, they have a contract that's a $10,000 contract. They sent the invoice to the customer and the customer has 60 days to pay. They don't want to wait 60 days. What will you give them today on that $10,000 invoice?
Yeah. So on that $10,000 invoice, we might advance them, $9,900 or something. And then, so there would be a $100 fee. It may range somewhere between, $9,000 and $9,900 out of that $10,000.
So how do you come up with that, right? So the effective cost of the capital advance is whatever the delta is between the 10K and what you advance. So what is that typically? Right.
Yeah, so it's typically somewhere in the range of 1 to 2% a month, or 1.5 to 2% a month. So the way we like to think about it is cheaper than giving a discount to your customer to getting paid early. And when you go and you talk to small business owners and ask them if they've ever given a discount to their customers, you'll get things in the range of, oh yeah, for sure, I've given a 2% discount or I've given a 10% discount. And nobody ever does sort of the APR on what that is. It's really on the margin. Yeah. And what we're trying to say is never do that. It's always better to use an invoice funding platform such as FundThrough, and obviously we want them to use FundThrough.
Well, I want to jump into that because you have a lot of people competing in this space, some from your backyard, right? So you have ClearBank that is doing a lot of this interesting thing. You've got Espresso, which was essentially shred financing. They're now getting more aggressive with RBFs and term loans even. SaaS Capital, Lighter Cap. There's so many people playing in this space. And then you have the pure play kind of, advanced, ARR advanced kind of solutions, like, or at least for SaaS, which it sounds like what you're doing, invoice advances. So if we did try and back in, the way to compare all these folks is to try and back into a true APR, right? So if I'm going to pay you, you're going to advance $9,900 on a $10,000 contract. So it's $100. That's what it costs me to save that 2 months, right? Multiply obviously at a year, that's $600 on 10K. You can back into essentially a 6% effective APR. Am I doing that math correctly?
Yeah, that math is correct. The other thing that I would say that is different is what's interesting is there are a lot of players in the capital space, and a lot of them you've just mentioned. They all actually do really different things, and it is our job and the industry's job to actually demonstrate to small business owners in which case you would want to use one versus another. The interesting thing about FundThrough is relative to say a loan, which was what the other ones that you were talking about are all loans, is that when you take a loan, you get the money up front and you spend the money, and that's great. But now the money's gone, and you hopefully have used it to generate revenue or more cash. But at some point, you've got to find a way to repay the loan.
Yep.
That's different than what we do. All we're doing is advancing your payment. So we are waiting so that you don't have to. But that ultimately your payment is going to come because you've delivered the goods or the service. So your invoice is going to get paid, and all you want to do is get paid faster. It wouldn't make sense if the check is in the mail and you have an opportunity to buy more inventory or want to make payroll, to take out a longer term loan with some of the folks that you may be referring to, if all you need is to bridge that short term gap.
So when did you leave the bank and launch this company?
So I moved back from New York to Toronto in 2009, and I never intended on starting this company. I went out there with the goal of actually going out and buying and operating a company. And
now, was Centerview a buyout firm? Were you doing kind of growth majority buyouts there?
No, Centerview was an M&A boutique investment bank. So it competed with Goldman Sachs and UBS and others. But all they did was M&A. They didn't have a financing arm. They didn't have a capital markets arm to it at that time. So when I moved back, the goal was to actually go out and buy a business. But when I spoke to all these small business owners, they would say things like, yeah, I'm interested in you telling me how much my business might be worth if you want to acquire it, but take into account that my customers are taking longer and longer to pay me. A bank won't lend to me because it was after the crisis and I might be asset light or too small or just don't fit their credit profile. And I've got this gap, but I've got a stack of purchase orders that if only I had the capital, I would be able to fill. And I've got a stack of invoices that are just taking longer and longer to pay. So I took a bit of a detour, and I had never heard the term factoring. I'm embarrassed to say today. Having an undergraduate degree in finance, having been working on Wall Street, having an MBA in finance, I had never heard the term factoring. But what I realized was that when you sell to high quality customers, you're creating an asset, and you should be able to use that asset and no other asset as a way of being able to get the capital that you need.
So what year was your first advance?
2014, June 2014, we made our first advance.
So, what the hell were you doing from between 2009 and 2014? That's 5 years of sailing in the Caribbean, or?
So between 2009 and 2014, so the first thing I did is I spent several months trying to figure out how to buy a business. Then I realized that, wait a minute, there's this thing called factoring. The best way for me to learn about factoring, because to me it sounded like the best way for you to fund yourself, off of the creditworthiness of who you sell to, not off of who you are, get unlimited access to capital simply by doing what you do best, which is sell. Sounded great. But the next question I asked was, why doesn't everybody do this? Why doesn't everybody know about it? So, I'm a curious guy, and I figured the best way to figure it out is to just jump right in. So I did. I jumped right in, and I created a factoring company.
Interesting. So that was, now, did you raise equity right off the bat to do these, or was it your own money?
That was my own money, and I got some friends and family to use money to lend out.
So what did you pay your friends and family back? Because you didn't have to manage the spread. So what did your first kind of debt financing? What was your cost?
At the time, the debt, with no track record and no history, I was paying 15%.
Okay.
And for at some point it was 15%, and for others it was just a sort of a profit share. It was debt, but it was a profit share of what I made by advancing that.
Yeah. So just to be clear, you essentially maybe were like the sole GP in a little fund, and you basically said, I won't give you a 15% hurdle. What I'll do is I'll just split. Just trust that I'm going to make a good spread here, and we'll do an 80-20 model.
That's right. Now, the way you say it, it sounds so sophisticated and it sounds amazing. I didn't think of it that way.
Well, it's hindsight, hindsight's 2020.
Yeah, exactly.
Well, the reason I'm positioning it that way in the context of this interview is because I want to now pull this forward, right? So what did you grow your loan tape to in 2014? How many kind of total advances did you do, GMV wise?
Well, so 2014 is when we launched FundThrough. So prior to that, it was not FundThrough. It was just, on my own book. When we launched FundThrough, the very first advance that we made was a $300,000 advance to a guy who was selling to Walmart and had never sold anything before. So he invented this tool. It was a really cool tool. He won Best in Show at his conference, and Walmart gave him an opening order. And we said, okay, we're going to take a risk because it's Walmart. We're going to fund it. The only thing I can promise you is we're going to charge you too much money. It's going to be really cumbersome. But I promise that you'll have founder level attention and we'll solve it. We'll be creative. And he's like, okay. He was an early adopter. He's like, okay, let's go for it. I think we charged him the equivalent of like 36% annualized. We didn't really know. And, we were trying to figure out what it is. And we advanced
3% a month. Yeah.
3% a month. Yeah. And we advanced the $300,000 and then didn't sleep for about 30 days waiting for it to come back.
The first payment. Yeah. Was it a month-long term or was it a 2-month term or?
That was about a 30-day term, but of course Walmart never actually pays on 30 days. So it ended up taking about 45 days.
Okay. So that's the good story of your first loan, but sum it all up for me. 2014, $300K, it sounds like it was a minimum. How many total, you add it all together, how much total advances did you do?
Yeah, that year, now you're getting me thinking. That year we probably did a couple $1 million, for sure less than $5 million.
Okay, less than, so call it between maybe 2 and 5 million, something like that. Okay, and then fast forward to last year. What did you do last year?
Yeah, so now last year in 2018, we were doing about $15 million a month.
Okay.
In advances.
And what will you break this year, you think?
And this year we're, we've crossed let's call it about $20 million. Going into 2020, we now have a bunch of really interesting channels and partnerships. It'll be somewhere between 20 and 30.
Yep. So just to be clear, in 2018, if you average, I don't know if this was an average, that's what I'm going to ask. 15 million a month would be about 180 million total recycled, that year. Is that right?
That's right.
And then you'll break 240 this year, 240 million.
That's right.
That's great. Okay. Yeah. And so the nature of these things is you essentially can go raise debt capital and lock your creditor's capital up for 4 years, but you're able to recycle this, and money velocity is critical. So help me understand how you have funded the business, both on the equity and debt side. How much equity have you raised for the company?
So all in, we've raised about $15 million in equity, going from angel seed rounds or seed extension to a Series A. And that's been primarily through local Canadian VC firms and high net worth individuals, sort of angels, call it. On the loan side, we started with high net worth individuals, not dissimilar to the story that I told you about how I started the other business, just asking around, who was interested. We did it in the form of debentures, where we would, have a variable rate of return based on the rate of return that we were able to generate with, the invoices.
So there was not a hurdle. It was more like they share on the upside.
Yeah, there was not a minimum. It was just what it is, what it was. But we knew what our minimum pricing was going to be, but we didn't know at that point what losses or anything was going to be.
Well, so go back to the first tranche of equity though, right? So you took 2.2 Canadian from Real Ventures in 2015. What story were you telling them to figure out what the valuation was going to be? Was it literally, here's the loan tape, here's the performance, I've de-risked this, it works?
Well, so it was a bit of a hope and a dream and a PowerPoint presentation with a little bit of traction.
Okay.
So the first advance was June 2014. We raised that 2.2 in February of 2015. So we had about 6 months to show that there were some users who actually liked it. And what we were able to show was that when users came on board, they were really sticky. They used us often. They were big invoices. The LTV seemed to be, it was still early, but seemed to be quite high. What we had no idea about was how to actually get a lot more users.
Yep.
So just based on that, we were able to say, okay, there's a huge market here. It's sort of motherhood and apple pie that, small businesses invoice and have to get paid. Everybody understands that gap, but are we able to actually bring in enough users to be able to make it worthwhile. And
so you did that first $2.5 million round, or about $2.5 million, with about between $2 and $5 million of loan tape history, right? Plus a PowerPoint. Help me understand. You don't have to give an exact number if you're not comfortable, but it was a while ago. What was the valuation you got on that first round?
Yeah, on that first round, the post-money valuation was about $8 million.
Okay, so six-ish pre, 5.8 pre.
Yeah.
Okay, interesting. And then, so fast forward, right? So the key to building a great business like this is to build a track record and then drive down your cost of capital. And then you can choose to either keep that extra spread for yourself and drive profit for yourself, or if you want to open your top of funnel, make your cost of capital cheaper to these e-commerce brands or these brands that do the invoicing. So what have you done? You started at 15% with friends and family money. You then did a $20 million debt financing, I believe, in 2016. Who was that with?
That was with a family office in Toronto, a Canadian-based family office.
And were you able to drive them to a deal that basically you were paying them way less than 15%?
I wouldn't say we were paying them way less. At that point we were paying about 11%.
Okay.
And now we finally got it into single digits, and we have to keep, as you say, keep driving it down.
Yeah. So
as we build our track record up, we'll continue to drive down.
Yeah. The last one, and correct me if this is wrong, but based on my research, June 2018, you raised $25 million, another more debt from Intercap.
Yes.
That's the one that you drove down to the single digits?
That's the one. Sorry, that's the one that was 11%.
Intercap.
Yeah.
Okay, Intercap was 11%. And sorry, what was the one in 2016? Was that also 11%?
The one in 2016 was variable. Was this? So the rates that they ended up getting were somewhere between sort of 12 and 14%, but it was variable.
Yeah. Okay, got it. That makes sense. So you moved to like a fixed hurdle model with the latest from Intercap.
That's right. Yeah.
Interesting. And loan tape. So up to in the decks that you worked with when you were negotiating with Intercap, how much history were you able to point to at that point? I mean, had you done more than 15 million in total kind of recycled money?
Yeah. If I remember correctly, we were just getting close to 100 million.
Okay. Wow.
So
that's interesting. It's impressive. You shaved 400 points off from 15% down to 11. But I would guess with that kind of history, like, why can't you go get back leverage from like an SVB or Bank of Toronto at like prime plus 1 or 2?
Yeah. So that's the next step. Now, what's important to note in this business is cost of capital being WACC and cost of debt. The beauty of a model that we have right now is that we have 100% advance rate. So our cost of debt is actually our total cost of capital. If we went to a bank... Wait,
I don't understand that. Give me a real number. Like, tell a story worth real numbers.
So for every dollar that we advance, we borrow $1. As opposed to, for every dollar we advance, we borrow 80 cents and we have to put 20 cents of equity.
You have no equity backstop, basically.
You have no equity backstop at this point. So it makes it sort of capital efficient for us to be able to go out to market. So the math that we have to do is when we go to a bank or a financial institution, and we can get it at LIBOR plus or Prime plus or whatever. What is the advance rate and what the total cost? When you account for the fact that you have to have some equity or sub debt, right? What's possible is that.
So do you feel like to get like LIBOR plus 1 or 2, you'd have to put up 10% equity into each advance?
We have to put some amount of equity. Now, equity or equity-like, we might be able to rent that equity by bringing on some additional loan capital at a higher rate, and the blended rate comes out lower.
Well, so let me ask you did your Series A of 9 million in June 2018 from Scale Up. You did, it looks like that exact same day, the Intercap kind of debt model. I mean, can't that 9 million in equity you raised actually equal purchasing power in the form of debt of like 90 million if you're putting up 10% equity?
Well, so what we ended up doing at that point is using our equity for 100% of the advances to the extent that we had it. So we're capturing the full margin.
Yeah.
Now there is some point if I were to do that though, I wouldn't be able to use that equity for operations, for marketing spend, for technology spend.
Is that significant? What's it cost you to actually run the business each month? Total expenses?
Well, we're growing quite quickly. So we're adding, growing in terms of top line, but also in terms of costs. So we are still burning money. We're in the stage where we would be a very nice profitable company if we chose to. But then on the side, we've got this technology spend, this product spend, and additional marketing spend.
So you start like net burn, you're talking like 200, 300 grand a month, something like that?
A couple $100,000 a month, yeah.
Yeah, and then total expenses as well, like 800, 900,000 bucks a month?
Probably a little bit more than that.
Okay, fair enough. Most of that's headcount?
Yep.
Yeah, what is headcount today? How many folks?
55.
55, all in Toronto?
No, we've got folks in Atlanta, folks in Denver, New York, Texas, Alberta.
Wow. How many engineers?
We've got about 15 engineers.
And how many quota-carrying sales reps?
So we have our sales model is an inbound sales model, not an outbound sales model. So they are commission-based, not necessarily quota-based. We've got 3 on the inbound sales, 2 on the customer success. It's really important to help on the existing users because they use us so often. And then we've got a manager that oversees them. And that area has been growing.
So what do you assume your total CAC is to get a new customer in the door, the first advance to them?
Well, what I would say is we've got some channels where we actually have what we would call zero CAC because we've got partnerships where we have sort of rev share models, and we love that. And we've got others with pay-per-click and digital and radio and other stuff where there would be CAC as you're describing. What we say is our ratio of LTV to CAC has been quite strong. Somewhere in the range of 7 to 9.
7 to 9. Now, what do you assume lifetime value is, though? Because that's a big question.
Pardon me?
What do you assume lifetime value is, though? Because that's a big question.
Yeah. Well, look, I'll talk about it in terms of ratio, not in terms of the number. What I would say is the lifetime value is actually quite high. It's much higher. So we can afford to spend that 7 to 9x LTV to CAC. And our short-term CAC will go up as we experiment with some new channels and some new potential partnerships. And that'll impact the ratio, but the LTV seems to be pretty constant. We're young. We're early still, so we're still trying to figure it out.
You can improve that. Yeah. Last couple of questions here. So 2019, you'll break $240 million this year in terms of advances done across how many companies?
Low thousands. So,
low thousands. Okay.
Yeah. Low single.
Like two, 3.
Yeah. 2 to 4,000.
Okay. 2 to 4K. Okay. That's pretty good. Very good. And then, any plans to raise capital? I mean, you raised over a year ago. It means you're raising capital probably right now, or you're selling to Cabbage. Which one is it?
So we're not selling to Cabbage. One day we'll buy Cabbage.
Oh, really? I like that. They're at they're $7 billion in loan tape. You got some work to do.
That's right. No, that's right. Well, maybe a year or 2.
Okay, fair enough.
We'll talk about a year or 2.
So are you raising
we'll be raising our next round of equity capital probably in the first half of 2020.
What's the right number? Like 18, 20 million?
Well, we're thinking it's hard to tell, actually. I mean, we're doing some what if scenarios actually right now about what we would do with the capital, and it could be anywhere from 18 to 50, depending on where we see that use of capital and the dilution that is associated with it.
And are you getting multiple, when you go out and have the valuation conversation, obviously because dilution is important. Let's say you go raise $20 million. Can you argue that you are truly a SaaS company and get a 5 to 20x on top line ARR in terms of your valuation?
Yeah, it seems to be what the market is saying, and it's how we operate. We are not we are a fintech player, but we are not a lender. We are a cash flow tool, and our users are, although not recurring, they are very sticky and repeating, and investors tend to see that.
Yeah, that's great. All right, let's wrap here with the famous 5. Number 1, favorite business book.
So my favorite business book is an old book called Pour Your Heart Into It by Howard Schultz, and it describes how he started Starbucks. I love it.
Number 2, Steven, is there a CEO you're following or studying?
Well, it's probably the same as everybody. I love Elon Musk. I love his ambition, and I love the way he operates.
Number 3, what's your favorite online tool for building your company?
Slack. Couldn't live without it.
Number 4, how many hours of sleep do you eat every night?
Oh, I sleep well. I'd say 7 hours a night. And
what's your situation? Married, single, kids?
Married with 3 kids.
Oh, wow.
4 if you count FundThrough.
Ooh, you are busy. Okay, and how old are you?
I'm 41.
41 years old. Okay, last question. What do you wish your 20-year-old self knew?
Wow. Travel more because when you get 3 kids, it's harder and harder. See the world and experience it.
Guys, FundThrough, they advance against your Invoices. 2014 made their first advance. His cost to capital was 15%. He'd lend out obviously above that. Did about between $2 and $5 million of loan tape in 2014. 2015 raised $2.2 million in equity capital on a $5.8 million pre-money valuation. So call it 6, 7, 8-ish post-money. 2016 got his cost to capital down from 15 to 12 to 14% variable basis on a $20 million line. And now he's driven his cost of capital down to call it 11% with Intercap in 2018, which is great. That means he can ideally pass those savings on to customers and give entrepreneurs cheaper loans at scale. This year, 2019, they'll pass over $240 million in essentially new Invoices advance. That's up from $180 million last year. This is across 2,000 to 4,000 founders building companies, hoping in 2020 to potentially raise another round of equity and probably debt as well. We'll see what happens. In the meantime, Steven, thanks for taking us to the top.
Thank you, Nathan.
You guys know I fight like heck to get these data points for you from these CEOs that rarely do these kinds of shows. If you want more shows like this, make sure you subscribe right now. We're trying to get 10,000 YouTube subscribers by the end of September here, 2019. And it would mean the world to me if you clicked now to subscribe. Additionally, I've got 2 more great interviews for you. If you want more data points from the world's leading SaaS CEOs, click and watch one of them right now.